Usually when we talk about a medical diagnosis, there's this expectation of precision.
Right. Yeah, like it should just be obvious.
Exactly. Like if you fall and break your arm, the x-ray shows this, jagged white line on a black background, and the doctor just points at it and says, there it is.
Yeah, it's binary, it's clean.
It is. It's comforting, honestly. I mean, we like things to be visible. We like them categorized.
Oh, for sure. We want to know exactly what's wrong.
But then you step into the world of corporate earnings calls. Especially for these massive, sprawling healthcare conglomerates. And suddenly that x-ray machine is it's fundamentally broken.
Oh, completely.
Yeah.
It's not a clear picture at all.
Right. We're looking at a diagnostic landscape of a company's financial health that is incredibly murky. And that murkiness is exactly why Wall Street was so terrified of Johnson & Johnson's Q2 2026 earnings call.
Yeah, the anticipation for this one was, it was intense.
It really was. Because for months, everyone thought the so-called Stelara cliff was going to just break the company's financial bones.
That was the narrative, yeah. The absolute doom and gloom.
But the x-ray we actually got today, it showed something entirely different.
It is the absolute definition of diagnostic muddy waters.
Yeah.
I mean, J&J isn't just a company, right? It's a bellwether for the entire healthcare sector.
Right. When they sneeze, the market catches a cold.
Exactly. But when they manage to sprint through a headwind like this, I mean, everyone has to reevaluate their portfolios.
Which is exactly what we are doing today. Welcome to Talk Tickers, the deep dive, where we break down corporate earnings calls for retail investors. Today, we are taking a data-forward, plain language look at J&J. Trading under the ticker J&J, by the way.
Good to specify, yeah.
Because we need to figure out if this is a buy, a hold, or a sell for you, the retail investor. We're going to strip away the polished public relations sheen from CEO Joaquin Duato and his executive team.
And there is a lot of PR sheen on these calls, let me tell you.
Oh, absolutely. So we're going to translate the jargon and look at the actual gears turning inside this machine. So let's start with the headline numbers, because out of the gate, they are staggering.
They really are. The scale is it's massive.
Worldwide sales for the second quarter hit $25.3 billion.
In one quarter.
In one quarter. That is up 5.6% operationally. And on the bottom line, their adjusted diluted earnings per share came in at 2.90. Which that's a 4.7% increase from the same quarter last year.
Those are massive figures. I mean, for a company of this sheer scale, you don't usually see that kind of nimble growth.
Right. It's like turning a battleship.
Exactly. But to really understand why Wall Street cares so much about that 5.6% operational growth, we have to talk about the boogeyman in the room. You mentioned it earlier, the Stelara cliff.
Yes. The boogeyman. And for anyone who hasn't been following the pharma space obsessively, Stelara was Johnson & Johnson's absolute flagship immunology drug.
The golden goose.
We are talking about a massive cash cow used to treat conditions like Crohn's disease and severe psoriasis. But it recently lost its patent protection.
Which triggers, frankly, one of the most brutal phases in a pharmaceutical company's life cycle. When a biologic drug like Stelara loses exclusivity, the market just gets flooded with what we call biosimilars.
I want to pause there because we hear generic drug all the time, right? But biosimilar is a very specific term. What is the actual functional difference for the business? Like, why not just call it a generic?
That's a great distinction to make. So a traditional generic drug is a simple chemical compound. Think of aspirin, right?
Okay, aspirin.
Once the patent on aspirin expires, another company can copy that chemical recipe perfectly, molecule for molecule. It's super cheap to make. And the price it drops by like 90% almost overnight.
Because anyone can make it in a lab.
Exactly. But a biologic drug like Stelara, it is manufactured inside living cells. It is incredibly complex.
Oh, wow. Okay.
Yeah. So you can't copy it perfectly. You can only make something that is highly similar and has no, clinically meaningful differences. That's why they call it a biosimilar.
Ah, okay. That makes sense.
Because biosimilars are so much harder to manufacture, the price doesn't drop to zero right away. But it still triggers this massive, aggressive war for market share. Because insurance companies, they immediately rush to cover the cheaper alternatives.
Right. They want to save money wherever they can. And looking at the transcript, that war was an absolute bloodbath for J&J. I mean, Stelara's sales crashed by 55.7% in a single quarter.
Yeah. More than half of the revenue from their biggest drug just evaporated. Gone.
That's terrifying for an investor.
Usually, Losing half the revenue of a multi-billion-dollar anchor product, it craters a pharma company's quarterly earnings. Investors completely flee.
I mean, I would.
Right, it's like a shopping mall losing its main anchor department store, you know? The foot traffic dies, and the whole ecosystem just suffers. But here is the major takeaway from this earnings call. Despite that 55.7% crash in Stelara, Johnson & Johnson still grew total revenue by 5.6%.
Which is just wild. The management team specifically noted that Stelara was a 460 basis point headwind to the total company.
Right.
And to translate that Wall Street speak for a second, a basis point is 1/100th of a percent. So 460 basis points means Stelara dragged their overall growth down by 4.6%.
Correct.
And they said it was a 760 basis point or 7.6% drag on the pharmaceutical division specifically. So if we completely remove Stelara from the equation,
The rest of the company actually grew at a double-digit rate.
that's insane.
Excluding Stelara, J&J posted double-digit growth. That is staggering. I mean, it proves that the underlying engine room of this company is generating enough power to not just offset a massive loss, but to push the entire ship forward at a faster clip.
Okay, I hear that, but I have to push back here. Because I'm looking at the transcript, and we always hear management tout these, quote, adjusted earnings, right? The adjusted EPS is 2.90, and they are taking a massive victory lap over it.
You definitely are.
But if you look at the GAAP EPS, generally accepted accounting principles, the actual strict legal accounting rules they have to follow the GAAP EPS is only 2.27.
Right.
That is flat. It's actually down 2 cents from a year ago. So what ugly realities are they hiding in that 63-cent gap between what they want us to look at and what the accountants are actually forcing them to report?
There is the exact right question to ask. And it's one every retail investor needs to scrutinize when they see adjusted numbers.
Yeah.
You can't just blindly trust the adjusted figure.
Right, because adjusted usually means ignore the bad stuff.
Exactly. To understand that 63-cent gap, you have to look at a specific line item on their income statement called Other Income and Expense.
Okay.
In Q2 2026, J&J reported a net expense of $331 million in this category. Last year, it was only $107 million.
That is a massive jump. What is actually sitting in that bucket draining all that cash?
The CFO, Joe Walk, he outlined it pretty clearly during the call. It is driven by three main things: higher litigation expenses, restructuring asset impairments, and residual costs related to spinning off their consumer health and orthopedics divisions.
Litigation. The eternal looming cloud over Johnson & Johnson.
It really is. It's a reality of their business model, unfortunately. They're always fighting legal battles.
Right, the talc lawsuits, everything else.
Exactly. But here is why Wall Street analysts and why you, as a retail investor, should generally focus on the adjusted EPS of 2.90 when evaluating the ongoing health of the business.
Walk me through that logic, because, I mean, if cash is leaving the building to pay lawyers, it's still cash leaving the building, right?
It is, yes. And you shouldn't ignore it entirely because it does impact their total cash reserves.
Yeah.
But think of J&J like a massive rental property portfolio. GAAP accounting includes absolutely everything. So if you have to pay a one-time legal fee to settle a property line dispute, or you pay to tear down an old unprofitable shed on the property, that reduces your total profit for the year. That's your GAAP number.
Right, the actual money you have left over.
But those are one-off events. They don't tell you how much monthly rent your tenants are reliably paying.
I see.
The adjusted EPS strips out the noise of those one-time legal settlements and structural spin-offs to show you the operational health of the core business. Basically, the actual rent being collected from selling drugs and medical devices. And that core operational health, generating 2.90 a share, remains incredibly robust.
Okay, so the translation is, yes, they are spending money cleaning up the house, remodeling, fighting legal battles, but the actual factory floor is churning out profits faster than ever.
Exactly. The core business is accelerating, even while dragging the dead weight of the Stelara patent cliff and all these restructuring costs.
So if the core business is hiding a healthy 2.90 EPS under all that litigation noise, we really need to know what's actually powering that factory floor.
We do.
Because looking at J&J is really like looking at two different companies wearing a trench coat. You have Innovative Medicine, which is their massive pharmaceutical division, and then you have MedTech, which manufactures surgical robots, heart pumps, contact lenses, that sort of thing.
It's a very diverse portfolio.
It is. And right now, these two divisions are telling very different stories.
They really are. I mean, the pharma division is operating operating with incredible momentum, while the MedTech division is dealing with some highly specific, localized friction.
Let's start with the momentum then. The Innovative Medicine division brought in $16.4 billion this quarter. That is up 6.8%.
It's huge.
Jennifer Taubert, the worldwide chairman of Innovative Medicine, she actually pointed out that this is their first ever $16 billion quarter. And again, this is happening while Stelara is in absolute free fall. Where on earth is this money coming from?
The sheer dominance they are showing in oncology, specifically in multiple myeloma, it is unparalleled.
Remind us what multiple myeloma is.
It's a cancer of plasma cells in the bone marrow. It is notoriously difficult to treat because the cancerous cells crowd out the healthy blood cells. J&J has essentially built an absolute fortress in this therapeutic area. Management noted that 80% of multiple myeloma patients receive one or more of J&J's medicines during their treatment journey.
Wait. 80%. Think about that market share. 80% of patients are using your products.
It's basically a monopoly on care.
And the king of that castle is a drug called Darzalex. This drug alone brought in over $4 billion in a single quarter. $4 billion. It grew 17.6% year over year. I can't even fathom a single product generating a $16 billion annualized run rate.
It has become the foundational treatment, and the growth isn't just from raising prices either. It's coming from massive market share gains in frontline settings.
Let's define frontline for a second. Why is that word so important?
Right, so in oncology, treatments are given in lines. If you are diagnosed with cancer, the very first treatment the doctor prescribes is the frontline therapy.
The first line of defense.
Exactly. If that stops working and the cancer relapses, you move to second line, then third line, and so on. Getting your drug approved and adopted as a frontline therapy is the holy grail for a pharma company.
Because they get the patient first.
Because patients stay on it the longest, and the patient pool is the largest. Darzalex is dominating that frontline space right now. But they aren't just resting on Darzalex, which is the crazy part.
They have more.
Oh yeah. Their newer next-generation multiple myeloma drugs are exploding in growth. Carvykti is up 47.7%. Tecvali is up 56.1%. Talvey is up 62.6%.
Okay, I want to dig into Tecvali because I was reading the Q&A section of the transcript, and an analyst from Morgan Stanley specifically asked about it. Taubert mentioned they just received a new FDA approval to use Tecvali in combination with Darzalex, creating a, quote, steroid-free immunotherapy option.
This is a huge deal.
Why is being steroid-free such a massive catalyst for a cancer drug? Like, why is that driving 56% growth?
It is a massive quality of life issue that dictates how long a patient can actually tolerate a treatment.
Right.
Historically, the standard oncology regimens for multiple myeloma involve very high doses of steroids, like dexamethasone.
Okay, so they need the steroids to make the drug work.
It helps kill cancer cells and reduces the immune system's inflammatory reaction to the treatment. But long-term steroid use is absolutely brutal on the human body. It causes severe insomnia, massive mood swings, bone density loss, and it increases the risk of serious infections.
Oh, wow. So the treatment is keeping you alive, but the side effects of the steroids are just making your life completely miserable, and eventually the body just can't take it anymore.
Precisely. So when J&J proves to the FDA that they can deliver this powerful immunotherapy combination of Tecvali and Darzalex without requiring the patient to endure high-dose steroids, it completely changes the calculus for the doctor and the patient.
That makes total sense.
It vastly improves the patient's quality of life, which means they can stay on the drug longer, which, from a business perspective means more revenue. But from a patient perspective, it means a better life.
And that leads directly to the clinical data they dropped on the call. Taubert noted that in their 3-year data for this combination, 83% of patients remained alive and progression-free.
In the oncology world, keeping 83% of relapsed multiple myeloma patients progression-free for 3 years is a total paradigm shift.
And progression-free means what exactly?
It means the cancer hasn't grown or spread. Doctors are seeing this data, seeing the lack of steroid toxicity, and they are moving these drugs earlier and earlier into the treatment cycle. In fact, management noted a 25% quarter-over-quarter expansion of Tecvali into community clinical sites.
Which is a huge detail. I noticed that too. They aren't just selling this to elite academic research hospitals in major cities anymore. They're pushing it into local community oncology clinics where the vast majority of everyday patients actually get treated.
Exactly.
That is where the real volume is.
It is. They have built an incredibly sticky ecosystem in blood cancers. But they're also making huge moves in solid tumors. The CEO, Joaquin Duato, he highlighted a drug called Rebrazon for lung cancer, which grew a staggering 61.6%.
Wow.
And they presented new data at the ASCO conference, the American Society of Clinical Oncology, for a prostate cancer drug called Erleada. The data showed that using Erleada both before and after surgery significantly reduces the risk of the cancer metastasizing or the patient dying.
So they are absolutely locking down oncology, but we can't ignore the immunology division. Because if Stelara is dying, something has to take its place. They can't just abandon that multi-billion-dollar market to their competitors.
They absolutely aren't. Enter Tremfya. This is the new star of their immunology portfolio. Sales for Tremfya grew 71% this quarter, hitting its first $2 billion quarter.
And here is the genius of their strategy based on the transcript. Tremfya is effectively eating Stelara's old market share. Taubert explained that in diseases like ulcerative colitis and Crohn's disease, Tremfya is now capturing over 50% of new induction share.
Yeah, induction share is a critical metric here. When a patient with severe Crohn's disease first goes to a gastroenterologist and the doctor decides it's time to start them on a biologic, that first prescription is the induction.
A starting point.
Management is saying that more than half the time a doctor writes that first prescription, they are choosing Tremfya over established competitors, like AbbVie's massive drug, Skyrizi.
Yeah, an analyst from TD Cowen asked about that exact rivalry during the Q&A. Tremfya versus Skyrizi. Why is Tremfya winning that head-to-head battle on the doctor's prescription pad?
It comes down to a combination of clinical data and mechanical convenience. First, the clinical data. Both drugs are what we call IL-23 inhibitors. They target a specific protein in the immune system that causes inflammation. But J&J just released data showing Tremfya is the only drug in its class to show efficacy in severe perianal fistulizing Crohn's disease.
I am not a doctor, but that sounds incredibly painful.
It is. It's a severe, debilitating complication where abnormal tunnels form between the bowel and the skin. It is notoriously hard to treat.
Oh, that's awful.
By proving Tremfya works on the most severe manifestations of the disease, it gives doctors the confidence to use it across the board. If it works on the worst cases, it'll work on the moderate ones. But the second reason it's winning is the delivery mechanism. Tremfya has a subcutaneous presentation.
Meaning a shot just under the skin.
Right. It utilizes a simple at-home auto-injector pen. Think of like an EpiPen. The patient can administer it themselves in their living room.
Instead of going to a hospital.
Exactly. Older biologics often require the patient to drive to a specialized clinic, sit in a chair, and receive an IV infusion for hours. The auto-injector completely removes that friction for the patient, which drives compliance, and it removes administrative friction for the doctor's office.
And they are stacking the deck even further with another new immunology drug, a psoriasis treatment called IcoTide. This part of the earnings call completely blew my mind. It is a daily pill, not an injection.
A pill is always better.
Right. Since its recent launch, over 18,000 prescriptions have been written for 11,000 patients. But here's a crazy stat. In just 90 days, IcoTide secured 50% commercial payer coverage.
That speed of insurance coverage adoption is almost unheard of in modern pharmaceuticals.
Why is it so fast? Usually, insurance companies fight tooth and nail to delay covering new drugs. I mean, they deny everything.
Because insurance companies are looking at the math. Biologic injections are incredibly expensive to manufacture, store, and ship. They require cold chain logistics. They have to be refrigerated. A daily chemical pill is vastly cheaper to produce and distribute.
So it's just a cost play.
If an insurance company can get a patient's psoriasis under control with a relatively inexpensive daily pill as a frontline treatment, they avoid having to pay for the multi-thousand-dollar biological injections down the road. J&J realized that the payer, the insurance company, is just as important as the patient. And they design a product that perfectly aligns with the payer's financial incentives.
Wow. Okay, so the innovative medicine division is clearly a well-oiled machine right now.
Unstoppable, almost.
Let's pivot to the other side of the trench coat then. Let's talk about the MedTech division. This division brought in $8.9 billion, but it only grew 3.6%.
Yeah, that's a bit of a letdown.
For a company targeting double-digit growth by the end of the decade, 3.6% is not going to cut it. It looks incredibly weak compared to the pharma numbers. I have to ask, what is going on here? They specifically called out a 2% decline in Abiomed, which makes heart recovery pumps. Did the products suddenly stop working? Are hospitals going broke?
This was undeniably the most tense part of the earnings call. And Tim Schmid, the worldwide chairman of MedTech, he had to spend a lot of time doing damage control on this specific issue.
I bet.
The weakness in Abiomed, specifically regarding their flagship Impella heart pumps, is entirely related to a recent clinical trial that came out of the UK.
Right. Schmid kept referring to it as a neutral study. What does that mean in this context? Neutral doesn't sound bad.
Well, the study looked at using these Impella pumps during high-risk PCI. PCI stands for a percutaneous coronary intervention. It's what happens when a patient has severely blocked arteries, and a cardiologist threads a catheter up into the heart to deploy a balloon or a stent to force the artery open.
Sounds intense.
In high-risk patients, the heart is already so weak that the physical trauma of the procedure itself could cause heart failure. So doctors insert an Impella pump temporarily to act as a crutch, pumping blood for the heart while the surgeon clears the blockage.
That sounds like a brilliant, necessary tool. So what did the UK study actually find?
The UK trial results were neutral, meaning statistically, the cohort of patients who had the pump didn't show a massive, undeniable survival benefit compared to the cohort of patients who didn't use the pump.
Uh-oh.
As a result, cardiologists read the headline, got spooked, and paused. They became, as management gently called it, highly selective about when to use the device.
Wait, if doctors in the UK are abandoning the pump based on actual clinical trial data, why should I, as an investor, believe J&J's excuse that this is just a temporary behavioral pause? Isn't that what every management team says when their product fails a trial and starts losing market share?
It's a very fair critique, and it's exactly why the stock saw some turbulence. But let's look at J&J's defense, which relies entirely on sample size and historical data.
Yeah.
Schmid emphasized to the analysts that the UK trial was incredibly small. It only looked at 300 patients total.
300 is nothing.
Right. J&J, on the other hand, has a proprietary registry with real-world clinical data on over 40,000 high-risk PCI patients. And historically, the Impella pump has been used successfully in over 400,000 patients globally.
So you have a sample size of 300 causing a panic, matched against a historical data set of 40,000 proving the efficacy.
Exactly. Think of the Impella pump like the engine in your car and this UK trial as a faulty sensor warning light on your dashboard.
Okay, I like that analogy.
The engine has run perfectly for 40,000 miles. Suddenly, a tiny sensor flashes red. The driver, in this case, the cardiologist, pulls over out of an abundance of caution. They aren't going to drive until they know it's safe. J&J's argument is that the engine is fine. They just need to go out, meet with the doctors, review the 40,000 patient data set, reset the sensor, and calm their nerves.
But they also admitted they have to wait for their own massive 1,300 patient clinical trial called PROTECT 4 to officially read out in 2027 to definitively prove the benefit and put this UK study to bed. And until then, as CFO Joe Walk admitted, growth in Abiomed will be, quote, modest.
Which is painful because J&J acquired Abiomed for $16 billion a few years ago. It was supposed to be a premium high-growth asset. Now they're dealing with a multi-year localized pothole.
And Abiomed wasn't the only pothole in MedTech. They also mentioned a 400 basis point headwind, so a 4% drag in electrophysiology due to, quote, China inventory issues. What does that actually mean?
Electrophysiology involves mapping and treating irregular heartbeats, often through ablation, where they use heat or cold to scar the heart tissue, causing the misfire. J&J is a massive player here. The underlying global demand for these procedures is actually very strong.
People always need heart surgery.
Management noted that without the China issue, the segment would have grown over 7%. But reported growth was dragged down to 3.1% entirely because of inventory destocking in China.
Let's translate inventory destocking for a retail investor who doesn't work in global supply chain management. What is happening on the ground?
It is a classic supply chain quirk.
Yeah.
Imagine a hospital in China usually keeps a 90-day supply of J&J's electrophysiology catheters in their supply closet. Due to shifting macroeconomic policies or changes in how the Chinese government procures medical devices, that hospital decides to reduce their stockpile. They decide a 30-day supply is enough.
Okay, so they stop buying.
For the next 60 days, they don't buy anything from J&J. They just use up the inventory they already have in the closet. To J&J's accountants, it looks like sales in China fell off a cliff.
Ah, but they are still doing the surgeries.
Yes. The actual number of heart surgeries being performed on patients hasn't changed. Once the hospital burns through the closet inventory and hits that 30-day mark, they will resume their normal purchasing cadence. It's a temporary accounting drag, not a fundamental decline in the product's demand.
Okay, so that explains the dragging angers. But the MedTech division wasn't entirely broken. Shockwave, another recent cardiovascular acquisition, grew 14.7%.
And Shockwave is fascinating. They use intravascular lithotripsy, essentially using sonic waves to safely break up hard calcified plaque inside arteries before placing a stent. It's incredible technology, and it's growing rapidly.
And the vision business, which includes AccuView contact lenses and surgical vision products for cataracts, grew 5.6%. So if you believe management's narrative, the 3.6% overall growth in MedTech is really just a temporary lull caused by a spooking trial and a Chinese supply chain quirk rather than a broken engine.
Which sets up a very interesting scenario for investors looking at the second half of the year. Do you trust the narrative, or do you trust the current X-ray?
Well, management certainly trusts their narrative, because despite the MedTech sluggishness, they didn't just survive Q2. They swaggered into the second half of the year. They actually raised their full-year guidance.
This is the ultimate show of confidence from an executive team. They bumped their operational sales growth estimates up by $400 million. They are now targeting 6.5% to 7.1% operational sales growth for the year. That brings the midpoint of their revenue guidance to $100.6 billion. Let me repeat that, $100.6 billion.
Insane.
They also raised their adjusted EPS guidance by 18 cents to a range of 11.50 to 11.65.
I just want to pause and let that revenue number sink in. In its 140-year history, Johnson & Johnson has never crossed $100 billion in annual revenue. This is a massive psychological and financial milestone.
It puts them in an incredibly elite company globally. Very few corporations on Earth, outside of tech monoliths and massive energy conglomerates, generate $100 billion in a single year.
I knew there was a but coming, though. Because I'm reading the fine print of the transcript, and Joe Walk, the CFO, casually mentioned that 2026 has a 53rd week of operations, and this extra week gives them a 100 basis point or 1% boost to their numbers.
Good catch.
So are they just artificially padding their numbers with a calendar quirk to cross the $100 billion finish line and collect their executive bonuses?
I love the skepticism. It is vital when reading earnings transcripts. To explain this, we have to look at how corporate financial calendars work. They don't always align perfectly with the standard 365-day Gregorian calendar.
Right.
Many retailers and healthcare companies use what's called a 445 calendar to ensure each fiscal quarter has exactly 13 weeks, and that every month ends on the same day of the week, which makes year-over-year quarterly comparisons much cleaner.
Okay, that makes sense for accounting.
But 52 weeks of 7 days is only 364 days. So every 5 or 6 years, the company has to add a 53rd week to realign their fiscal calendar with the actual end of the year. It's essentially a leap year for corporate accounting.
So because of this accounting quirk, they get an entire extra week of selling Tylenol, contact lenses, surgical staplers, and cancer drugs across the entire globe packed into their fourth quarter.
Exactly.
That is a staggering amount of extra revenue.
It is. It accounts for about 1% of their total annual growth. But here is why I don't think it's just artificial padding. Even if you strip away that 100 basis point boost, they were still guiding for 5.5% to 6.1% underlying operational growth.
Still really strong.
For a $100 billion behemoth to grow at nearly 6% organically, while simultaneously shedding a massive patent cliff like Stelara, is incredibly difficult to execute. They aren't just coasting over the finish line on a calendar technicality. They have actual tangible pipeline catalysts driving this confidence.
Let's talk about those catalysts. Because management claimed on the call that they have a clear line of sight to double-digit growth by the end of the decade. That is a bold claim for a company this size. Where is that growth supposed to come from?
It comes down to 3 specific levers: upcoming FDA approvals, major pipeline data readouts, and aggressive strategic acquisitions. Let's start with approvals. Over in MedTech, the biggest catalyst they are teasing is OTAVA.
The robotic surgical system.
Exactly. They're anticipating FDA authorization for the OTAVA system very soon. This is designed specifically to take on the current monopoly in soft tissue robotic surgery, which is Intuitive Surgical's Da Vinci system.
Oh, I've heard of Da Vinci. They're everywhere.
Right now, if a hospital wants to do robotic surgery for a hernia repair or a prostatectomy, they almost certainly buy a Da Vinci. J&J believes OTAVA's unique architecture, which integrates seamlessly into the operating room table rather than being a massive standalone cart, and its integration with their digital mapping ecosystems, will finally give surgeons a viable, potentially superior alternative.
Hospitals love competition because it drives down prices.
Exactly. So the market is incredibly hungry for a true competitor to Da Vinci.
And over in the pharma division, they have major data readouts coming. The one that caught my eye, because the market size is so huge, is Milvexian.
Ah, Milvexian. This is an oral anticoagulant, a blood thinner, aimed primarily at patients with atrial fibrillation, or AFib, which is an irregular heartbeat that can lead to blood clots and strokes.
John Reed, the head of R&D for J&J, mentioned that the milvexian trial is an event-driven study. Stop me there. What does that mean for an investor waiting for news? Do we know exactly when the data is coming out?
We don't. And that's the nature of an event-driven study.
Yeah.
A traditional trial ends on a specific date, say, after exactly 12 months. An event-driven study ends when a predetermined number of clinical events, in this case, strokes or major bleeding incidents, occur across the entire patient population.
Oh, so they just have to wait for enough bad things to happen to measure it.
Exactly. The trial just runs until they hit that statistical threshold. Once they do, they unblind the data and see if the patients taking milvexian had fewer strokes than the patients taking the standard of care.
Okay, but why is milvexian such a big deal? Don't we already have effective blood thinners on the market?
We do, but they come with a massive, terrifying trade-off. A high risk of severe, uncontrolled bleeding. The human coagulation cascade, the process that makes your blood clot when you get a cut, is incredibly complex.
Right.
Current blood thinners stop clots, but they also stop the body's ability to heal minor internal injuries, leading to dangerous bleeding in the brain or stomach. Milvexian is a factor inhibitor. It targets a very specific pathway in the coagulation cascade. The theory is that it can prevent pathological blood clots in the heart while preserving the body's natural ability to stop bleeding from a cut.
Which would be the holy grail of cardiology.
Yeah.
Jennifer Taubert pointed out on the call that there are about 18 million people in the U.S. alone who objectively should be taking an oral anticoagulant to prevent a stroke, but only 8 million actually are.
That gap is huge.
Why? Because doctors are terrified of the bleeding risk for those other 10 million older, frail patients. If milvexian proves it can prevent clots without the bleeding risk, it unlocks a massive, untapped, multi-billion-dollar market.
It changes the standard of care globally overnight. And they're also waiting on data for the Sunrise program in bladder cancer using a drug called Inlexo. This is a brilliant fusion of their drug and device capabilities.
Fusing them together.
Yeah. They noted there are over 1 million patients globally with bladder cancer. The standard of care right now often involves systemic chemotherapy, which is brutal, or having to go into a clinic every few weeks to have medicine instilled into the bladder through a catheter.
Neither of which sounds pleasant.
No. J&J's innovation with the Sunrise program isn't just the drug itself, it's the delivery mechanism. They've created a small, flexible device called TAR-200. It looks a bit like a tiny pretzel.
A pretzel?
Yeah, a tiny silicone pretzel. Adapter inserts it into the bladder, and it slowly, continuously releases the targeted cancer medicine directly into the bladder tissue for 3 solid months.
So instead of a massive toxic dose of chemo pulsing through your whole body every 3 weeks, your bladder gets a localized, continuous dose 2,000 sufina.
Exactly. It maximizes the drug's contact time with the tumor while minimizing the systemic side effects for the rest of the patient's body. If the data holds up, it completely rewrites how localized bladder cancer is treated.
So they have robotic approvals pending, they have massive data readouts coming, but if they can't invent it, they are perfectly happy to buy it. That's the third catalyst, right? Strategic acquisitions. On the call, they announced plans to acquire a company called Firefly Bio, which targets KRAS-driven solid tumors.
KRAS mutations are one of the most common drivers of cancer, particularly in lung and pancreatic cancers. For decades, oncologists referred to KRAS as undruggable because the protein shape made it incredibly difficult for a drug molecule to bind to it.
But they figured it out.
Only recently have companies cracked the code. J&J's CFO made it very clear. They have $21 billion in cash on hand. They generate massive free cash flow every quarter. And they are aggressively willing to buy their way into future growth if the science aligns with their commercial capabilities.
Oh.
They are buying Firefly to get a foothold in that KRAS market before it explodes.
So what does this all mean? We have gone through the headline data, we've broken down the divisions, and we've analyzed the guidance. I want you to pull it all together. Based strictly on this earnings call transcript and the mechanisms we just discussed, is this a bullish or a bearish signal for retail investors? Take a stance.
I am taking a strong, unequivocally bullish stance on Johnson & Johnson coming out of this quarter.
Okay, defend the thesis. Why?
Because the biggest existential threat to J&J stock over the last 2 years, the dark cloud hanging over every Wall Street valuation model, was the Stelara patent cliff. The market hates uncertainty, and nobody knew exactly how badly the flood of biosimilars would erode their top line. This Q2 earnings call was the ultimate proof of concept.
Because they survived it.
They took the hit. Stelara fell by over 55%, and the company not only survived, it grew by 5.6%.
They absorbed the heaviest punch the market could throw at them, and they just kept moving forward.
Exactly. They proved they aren't reliant on a single golden goose anymore. Management noted they now have 28 different product platforms generating over $1 billion annually.
28 different billion-dollar products.
The sheer diversification of their revenue streams, from multiple myeloma treatments to contact lenses to surgical staplers to psoriasis pills, creates a massive margin of safety for the investor.
So let's make this highly actionable for you, the listener. If you are a retail investor and you already hold J&J stock in your retirement account, what is your takeaway today?
If you hold J&J, this is what we call the sleep well at night quarter. Your dividend is incredibly safe. They generated $8.7 billion in free cash flow just in the first half of the year. They are on track for over $20 billion in free cash flow for the full year.
That is a lot of cash.
And the pharma pipeline is producing massive new hits like Tremfya and IcoTide to replace the old ones. You hold the stock, you collect your dividend, and you watch them march toward that $100 billion revenue milestone.
Okay, but what if you don't own it? What if you are sitting on cash, looking at this transcript, considering buying in? Because that MedTech softness, we talked about the AbbVie trial scare and the China inventory issues, that seems like a legitimate drag on the stock price.
It is a drag, and it is actively creating a slight depression on the stock price in the near term as institutional investors fret over hospital procedure volumes. But if you understand the mechanisms behind that drag, this is a classic buy the temporary dip scenario for a blue chip stock.
Because the MedTech issues are temporary.
Right. They are behavioral and supply chain related. They are not fundamental flaws in the technology itself. Meanwhile, the underlying pharma engine is incredibly strong and growing at double digits. You have a chance to buy into a company that is poised for a massive acceleration in 2027, while the market is currently distracted by a localized MedTech warning light.
That makes a lot of sense. You're essentially buying the pharma acceleration at a discount while getting the inevitable MedTech recovery for free.
That is exactly how I view it. And with their aggressive expansion into high-growth areas like soft tissue robotics and AI-powered imaging, the long-term thesis is very much intact.
Which brings me to a final thought I want to leave you, the listener, with today. We talked a lot about chemical pills, biological injections, and mechanical heart pumps. But look closely at the language management is using around their surgery division.
Yeah, it's shifting.
They are heavily pushing this new OTAVA surgical robot, aiming directly at established hardware monopolies. But it is not just about the hardware anymore. On the call, they highlighted a massive investment in AI-powered mapping, specifically something called CardoSound Sonata in their electrophysiology division. And they kept using the phrase polyphonic open digital ecosystem to describe how they provide data-driven insights to surgical teams during an operation.
It sounds significantly more like a Silicon Valley software pitch than a traditional healthcare company presentation.
Right. So here is the thread I want you to pull on your own. With all this digital integration, AI spatial mapping, and robotic architecture, is Johnson & Johnson quietly transforming from a traditional pill and device maker into a high-tech medical robotics and data company?
That's a great question.
Keep a very close eye on their MedTech margins over the next few quarters. If those AI and software ecosystems start generating recurring high-margin subscription revenue from hospitals, this stock could be reevaluated entirely by the market. They wouldn't just be valued as a pharma company, they'd be valued as a tech company.
It's a fascinating transition to watch. We started this deep dive by saying we like things to be visible and strictly categorized, but J&J is proving that sometimes the most profitable reality for an investor is the one where a company constantly blurs the lines of what it actually is.
The murky diagnostic landscape strikes again. Thank you so much for joining us on this deep dive into Johnson & Johnson's Q2 results. Stay curious, keep reading the fine print in those transcripts, and keep your portfolios sharp. We'll catch you on the next one.